Welcome to Book Mint, the podcast where we distill the wisdom of financial giants and bring you actionable insights to empower your investment journey. I'm your host, and today we're diving deep into a true classic, a book that has revolutionized how millions approach the stock market. John Bogle's The Little Book of Common Sense Investing, the only way to guarantee your fair share of stock market returns. Before we begin this enlightening journey, if you find our content valuable, please hit that like button, share this episode with anyone who needs to hear this wisdom, and subscribe to BookMint for more insightful book summaries and financial wisdom. Your support helps us grow and continue bringing you the best of the best. Now, let's talk about John Bogle. He was a visionary, a maverick, and the founder of Vanguard Group, one of the world's largest investment companies. More importantly, he was the inventor of the index fund, a financial innovation that has democratized investing and saved investors billions of dollars in fees. Bogle's core philosophy, as encapsulated in this book, is disarmingly simple yet profoundly powerful. Invest in low-cost, broadly diversified index funds and let the magic of compounding do the rest. In a world filled with complex financial products, high-flying stock tips, and expert predictions that often fall flat, Bogle's message cuts through the noise like a beacon of common sense. He argues that trying to beat the market is a loser's game for most individual investors, and the smartest strategy is simply to own the entire market at the lowest possible cost. So, buckle up as we explore each chapter of this essential guide, unraveling Bogle's timeless principles and equipping you with the knowledge to secure your financial future. Chapter 1: A Declaration of Independence. In this foundational chapter, John Bogle sets the stage for his revolutionary approach to investing, declaring an independence from the traditional, often self-serving active management industry. He immediately challenges the deeply ingrained belief that investors can consistently beat the market through skillful stock picking or market timing. Bogle argues that for the vast majority of investors, this pursuit is not only futile but also detrimental to their long-term wealth accumulation. He starts by asserting a simple yet profound truth. The financial markets are ultimately a zero-sum game before costs. What one investor gains above the market average, another investor must lose below it. However, once you factor in the substantial costs associated with active management, advisory fees, trading costs, marketing expenses, and bid-ask spreads, the game transforms into a negative-sum game for investors as a group. Every dollar paid in fees is a dollar subtracted directly from investor returns. Bogle introduces the concept of the index fund as the antidote to this negative-sum game. He describes it as a common-sense approach that allows investors to capture their fair share of market returns, which is simply the market's total return minus a minuscule expense ratio. He contrasts this with actively managed funds, which, despite charging significantly higher fees, statistically fail to outperform their benchmarks over the long run. He presents compelling historical data demonstrating that the aggregate return of all investors in the market before costs is, by definition, the market's return itself. After costs, the aggregate return is necessarily less than the market's return. The Declaration of Independence is about liberating investors from the tyranny of excessive costs and the illusion of superior stock-picking ability. Bogle emphasizes that investors don't need to try and find the needle in the haystack. They can simply buy the entire haystack. This chapter lays the groundwork for the entire book, establishing the fundamental premise that low-cost index investing is the most rational and effective strategy for long-term wealth creation. It's a call to arms for individual investors to reclaim their financial destiny from the hands of an industry that often prioritizes its own profits over the returns of its clients. Bogle's passion for the individual investor shines through as he champions a simple, transparent, and undeniably effective approach. Chapter 2: The Enormous Advantage of the Index Fund. Chapter 2 delves deeper into the practical and statistical advantages of index funds, building upon the theoretical framework established in the first chapter. Bogle unequivocally states that the enormous advantage of the index fund stems primarily from its cost efficiency and its inherent ability to consistently capture market returns. He meticulously breaks down the components of returns and costs. Investors' returns, he explains, are comprised of the market's total return minus the costs they incur. These costs include expense ratios, trading commissions, portfolio turnover costs, and taxes. Actively managed funds, by their very nature, incur significantly higher costs across all these categories compared to index funds. Expense ratios. Bogle highlights that even seemingly small differences in annual expense ratios can lead to colossal differences in wealth accumulation over decades due to the power of compounding. He provides compelling examples of how a 1% or 2% annual fee, when compounded over 30 or 40 years, can easily erode half or more of an investor's potential returns. Index funds, particularly those offered by Vanguard, boast expense ratios that are often 10 to 20 times lower than actively managed funds. Portfolio turnover. Active managers constantly buy and sell stocks in an attempt to outperform the market. This high portfolio turnover generates significant transaction costs, commissions, bid-ask spreads, and, crucially, triggers capital gains taxes, which are often passed on to fund shareholders. Index funds, by contrast, have extremely low turnover, as they only buy and sell when necessary to mirror changes in their underlying index, e.g. when a company enters or exits the S&P 500. This dramatically reduces trading costs and defers capital gains taxes, making them significantly more tax efficient. The power of compounding. Bogle underscores that the true magic of investing lies in compounding returns over long periods. However, excessive costs act as a reverse compounder, systematically siphoning off a portion of those returns before they can even begin to multiply. By minimizing costs, index funds allow the full force of compounding to work for the investor. The futility of active management. Bogle presents statistical evidence showing that, year after year, the vast majority of actively managed funds fail to beat their benchmark indexes. He attributes this failure not to a lack of effort or intelligence on the part of fund managers, but to the insurmountable hurdle of costs. Even if a manager possesses genuine skill, the drag of high fees often negates any potential alpha they might generate. He uses the analogy of a horse race where all the horses are equally fast, but some have to carry significantly heavier lead weights, costs. The lighter horses, index funds, will almost always win. He further clarifies that while some active managers might outperform in the short term, identifying these winners in advance and ensuring their continued success is virtually impossible. Past performance is not indicative of future results, and many funds that shine brightly for a few years eventually fade into mediocrity.
In essence, Chapter 2 systematically dismantles the arguments for active management and makes an irrefutable case for the superior mathematics of index investing. It's about understanding that in investing, simplicity, low cost, and long-term perspective are the true engines of wealth.
Chapter 3: How the Experts Fail. In How the Experts Fail, John Bogle pulls back the curtain on the financial industry, exposing the inherent flaws and conflicts of interest that often lead active managers to underperform. This chapter is a scathing critique, backed by data, of why the experts, financial advisors, fund managers, and market strategists consistently fail to beat simple market benchmarks, especially after factoring in their substantial fees. Bogle begins by reiterating the core truth. The financial market is a zero-sum game before costs and a negative-sum game after costs. This fundamental principle means that for every actively managed fund that outperforms the market, another must underperform by an equal amount, before costs. Once fees are introduced, the aggregate return of all active managers must fall below the market average. It's a mathematical certainty, not a matter of skill or luck. He then systematically outlines the reasons for this pervasive underperformance. High costs. This is the primary culprit. Active funds carry significantly higher expense ratios, trading costs due to high portfolio turnover, and marketing expenses than index funds. These costs act as an insurmountable hurdle that most managers simply cannot overcome. Bogle emphasizes that the mirage of gross returns often hides the reality of net returns for investors. While some funds might achieve decent gross returns, their high fees devour a substantial portion of that performance. The fickle nature of skill. Even if a fund manager possesses genuine skill in identifying undervalued stocks or making astute market calls, Bogle argues that such skill is rare, often fleeting, and notoriously difficult to identify in advance. He points out that star managers often regress to the mean, and funds that outperform for a few years rarely maintain that outperformance over the long haul. The search for the next hot fund is often a wild goose chase. Conflict of interest. Bogle highlights the fundamental conflict of interest inherent in the active management industry. Fund managers and financial advisors are primarily compensated based on the assets they manage, assets under management, or AUM, not necessarily on the net returns their clients receive. This incentivizes them to gather more assets, often through aggressive marketing and the promotion of new, complex products, rather than to maximize investor returns through low-cost, efficient strategies. High fees mean more revenue for the fund company, regardless of investor outcomes. Behavioral biases. While not explicitly focusing on investor psychology, Bogle implicitly touches on how human biases affect both managers and investors. Managers can fall prey to overconfidence, herd mentality, and the pressure to conform, leading to suboptimal investment decisions. Investors, on the other hand, are often swayed by hype, recent performance, and the allure of expert advice, leading them to chase performance and make poor timing decisions. Market efficiency. Bogle implicitly argues for a strong form of market efficiency, at least concerning active management. In a highly competitive market populated by millions of well-informed participants and sophisticated algorithms, finding consistently mispriced assets is exceedingly difficult. Any advantage is quickly arbitraged away. Bogle presents compelling statistical evidence year after year showing the vast majority of active funds failing to beat their respective benchmarks. He cites studies that demonstrate that even top-performing funds in one period rarely remain top performers in subsequent periods. He concludes that the financial industry, despite its claims, often sells hope and complexity rather than reliable long-term wealth creation.
This chapter serves as a wake-up call, urging investors to be skeptical of claims of superior foresight and to instead embrace the humble but powerful strategy of indexing.
Chapter 4: The Relentless Rules of Humble Arithmetic. Chapter 4 is the heart of Bogle's mathematical argument for index investing. Here, he distills his philosophy down to its most fundamental and irrefutable principles, focusing on the relentless rules of humble arithmetic. This chapter emphasizes that investing success is not about arcane formulas or complex strategies, but about understanding basic mathematics and the profound impact of costs and time. Bogle's core assertion is that investing returns are determined by two primary factors: the actual return of the capital markets and the costs incurred by the investor. He uses simple yet powerful arithmetic to illustrate how costs, even seemingly small ones, relentlessly erode investor wealth over the long term due to the power of compounding. He begins by stating the cost matters hypothesis. This hypothesis posits that the total return of the market is shared among all market participants. Before costs, all investors as a group earn the market return. After costs, the aggregate return for investors as a group must necessarily be less than the market return by precisely the amount of those costs. This is not a theory, it's a mathematical identity. Bogle then meticulously demonstrates this through examples. The gross return versus net return illusion. He explains that while fund companies often trumpet their gross returns before fees, what truly matters to investors are their net returns after fees. A fund might claim to have beaten the market by a small margin before fees, but once a 1 to 2% expense ratio is applied, it almost invariably falls behind. The compounding of costs. This is perhaps the most crucial lesson of the chapter. Bogle provides stark illustrations of how a mere 1% or 2% annual fee, when compounded over 30, 40, or 50 years, can consume an astonishing proportion, often 50% or more, of an investor's potential final portfolio value. He shows side-by-side comparisons of two hypothetical investments, one with low costs and one with high costs, demonstrating how the low-cost option dramatically outperforms over time, even if both investments achieved identical gross returns. He refers to this as the tyranny of compounding costs. Portfolio turnover's hidden costs. Beyond explicit expense ratios, Bogle highlights the hidden costs of high portfolio turnover in actively managed funds. These include brokerage commissions, bid-ask spreads, and the often overlooked cost of capital gains taxes triggered by frequent trading. Index funds with their minimal turnover avoid most of these drags on return, further enhancing their arithmetic advantage. The winner's game versus the loser's game. Bogle contrasts investing with other competitive endeavors. In games like tennis, winning often involves making brilliant shots, a winner's game. In investing, however, he argues it's a loser's game, where success comes not from making brilliant moves, but from avoiding mistakes, particularly the mistake of paying high costs. The winning strategy is to minimize errors by simply capturing the market's return at the lowest possible expense. He emphasizes that investing is about probability and long-term averages. While a few active managers might beat the market for a time, the probabilities are overwhelmingly against any individual investor choosing such a fund and sticking with it for decades. The humble arithmetic dictates that the surest way to capture your fair share of market returns is to own the market itself as cheaply as possible.
This chapter strips away the complexity and marketing fluff of the financial industry, revealing the underlying mathematical truths that govern investment outcomes. It's a powerful and persuasive argument for embracing simplicity and cost consciousness as the cornerstones of a successful investment strategy.
Chapter 5: The Grand Compromise. In The Grand Compromise, John Bogle introduces the concept of the total stock market index fund as the ultimate embodiment of his investment philosophy. He presents this type of fund as the ideal solution, offering a grand compromise between the desire for broad diversification and the need for simplicity and low cost. Bogle explains that while a simple S&P 500 index fund is an excellent choice for many, a total stock market index fund goes a step further by including virtually every publicly traded U.S. company, from large caps in the S&P 500 to mid caps, small caps, and even micro caps. This provides even broader diversification and ensures that the investor owns a slice of the entire American economy. He highlights several key advantages of this grand compromise. Maximum diversification. By owning the entire market, investors eliminate specific company risk, the risk that a single company's stock will perform poorly. They are also diversified across different market capitalizations, ensuring exposure to all segments of the economy. This broad diversification is the most effective way to mitigate risk without sacrificing potential returns. Elimination of stock-picking risk. With a total market index fund, there's no need to try and pick individual winning stocks or even winning sectors. The fund automatically owns them in proportion to their market capitalization. If any segment of the market performs well, the investor participates. If another performs poorly, its impact is minimized by the vast diversification. Low cost. Like other index funds, total stock market index funds are passively managed, leading to extremely low expense ratios. This adherence to Bogle's cost matters hypothesis is central to their long-term outperformance over actively managed alternatives. Tax efficiency. Due to their extremely low portfolio turnover, total market index funds are highly tax efficient. They generate fewer capital gains distributions, allowing investors to defer taxes until they sell their shares, thus maximizing the power of compounding. Simplicity. Bogle continually champions simplicity. A single total market index fund can form the core or even the entirety of an equity portfolio, making investing straightforward and easy to manage. This frees investors from the endless, often fruitless task of researching individual stocks or actively managed funds. Guaranteed market returns. By owning the entire market, investors are guaranteed to earn the market's return, minus minimal costs. They will never lag the market over the long term due to poor stock selection or high fees. This guaranteed of market returns, Bogle argues, is the ultimate winning strategy in a game where beating the market is a statistical rarity for active managers. Bogle also addresses the inclusion of small-cap and mid-cap stocks. He acknowledges that these segments can sometimes outperform large caps, and a total market fund ensures participation in any size premium that might exist. Conversely, if large caps lead, the fund also captures that performance. It's a set-it-and-forget-it strategy that ensures participation in whatever segments of the market thrive over time. The Grand Compromise is Bogle's ultimate recommendation for equity exposure. It represents the pinnacle of his common-sense approach, providing maximum diversification, minimal cost, and guaranteed market returns through a single, elegant investment vehicle. It's about letting the market work for you rather than trying to outsmart it. Chapter 6. Bonds in your portfolio. In Chapter 6, John Bogle shifts his focus from equities to the often overlooked but crucial role of bonds in a well-diversified investment portfolio. He emphasizes that while stocks are essential for long-term growth and combating inflation, bonds serve a distinct and equally vital purpose: reducing portfolio volatility, preserving capital, and providing a stable income stream. Bogle advocates for a balanced portfolio, asserting that an asset allocation strategy that includes both stocks and bonds is generally superior to an all-stock portfolio for most investors, particularly as they approach or enter retirement. He stresses that the optimal allocation between stocks and bonds is highly individual and depends on several factors. Risk tolerance. Investors with a lower tolerance for risk and market fluctuations will generally need a higher allocation to bonds. Bonds provide a shock absorber during stock market downturns. Investment horizon. Younger investors with a longer time horizon can typically afford to take on more stock market risk. Older investors, or those nearing retirement, usually benefit from a higher bond allocation to protect their accumulated capital. Bogle often suggests a simple rule of thumb: your bond allocation should roughly equal your age. Financial goals. The specific financial goals of an investor, e.g., retirement, down payment on a house, child's education, will also influence the appropriate stock-bond mix. The role of bonds. Volatility reduction. Bonds tend to be less volatile than stocks, especially high-quality government and corporate bonds. When the stock market experiences a correction or bear market, bonds often hold their value or even appreciate, providing a ballast to the overall portfolio. Capital preservation. For investors concerned about protecting their principal, bonds offer a relatively safer haven compared to stocks, though they are not entirely risk-free. Inflation risk, interest rate risk, credit risk. Income generation. Bonds provide a predictable stream of income through interest payments, which can be particularly attractive for retirees or those seeking supplemental income. Diversification. Bonds offer true diversification from stocks because their returns are often uncorrelated or even negatively correlated with stock returns, especially during times of market stress. Bogle's recommendations for bond investing. Just with stocks, Bogle applies his common-sense, low-cost indexing philosophy to bond investing. He strongly recommends low-cost bond index funds rather than individual bonds or actively managed bond funds. Total bond market index funds. Similar to his recommendation for total stock market funds, Bogle advocates for a total bond market index fund. This type of fund invests in a broad array of U.S. government, corporate, and mortgage-backed securities, providing instant diversification across the entire bond market. This approach eliminates the need to pick individual bonds, which can be complex and risky for individual investors. Emphasis on high quality. He advises sticking to high-quality investment-grade bonds or funds that hold them to minimize credit risk, the risk that the issuer will default. Avoid high-cost active bond funds. Bogle shows that active bond managers, like their equity counterparts, also struggle to consistently beat their benchmarks after fees. The bond market is highly efficient, and the cost drag of active management makes outperformance exceedingly difficult.
Consider Treasury inflation-protected securities, TIPS. For investors particularly concerned about inflation, Bogle suggests including TIPS in their bond allocation. Bogle reiterates that a diversified portfolio comprising both low-cost stock index funds and low-cost bond index funds provides the optimal blend of growth potential, risk reduction, and income generation for the vast majority of investors. The key is to find an allocation that aligns with one's individual circumstances, and then stick with it.
Chapter 7: The Eclipse of the Sun King. The Eclipse of the Sun King is a more reflective and somewhat philosophical chapter where John Bogle laments the excessive complexity, speculation, and self-serving nature that has come to dominate the mutual fund industry. The Sun King metaphor refers to the traditional, actively managed mutual fund industry, which Bogle views as having lost its way, prioritizing its own profits and perceived grandeur over the best interests of its clients. Bogle contrasts the original noble purpose of mutual funds to provide a simple, diversified, and professional investment vehicle for the common investor with its current state, which he sees as increasingly focused on short-term trading, aggressive marketing, and the pursuit of speculative returns. Key themes in this chapter include shift from long-term investing to short-term speculation. Bogle argues that the industry has drifted away from true long-term investing, which involves owning businesses for decades, towards short-term speculation. Fund managers are often pressured to produce quarterly returns, leading to excessive trading, high portfolio turnover, and a focus on fleeting trends rather than fundamental value. This short-termism directly harms long-term investors through increased costs and taxes. The rise of market timing and hot funds. He criticizes the pervasive marketing of hot funds and the illusion that investors can consistently profit from market timing or sector rotation. This marketing fuels investor irrationality, encouraging them to buy high and sell low, chasing past performance that rarely persists. The fiduciary duty betrayed. Bogle expresses deep concern that the mutual fund industry, by charging exorbitant fees and promoting complex, often underperforming products, has fundamentally betrayed its fiduciary duty to put clients' interests first. He argues that the industry has become a business for itself rather than for the investor. Complexity as a marketing tool. Bogle suggests that complexity often serves as a marketing tool, creating an aura of expertise and justifying higher fees. He champions simplicity, arguing that the simplest investment strategy, indexing, is overwhelmingly the most effective. The power of investor behavior. While the chapter primarily critiques the industry, Bogle implicitly acknowledges the role of investor behavior. Investors often fall prey to emotions, fear, and greed, leading them to abandon sound investment principles in pursuit of elusive alpha. The industry, in turn, capitalizes on these behavioral biases. The triumph of indexing as a solution. Despite his criticisms, Bogle offers a solution: the index fund. He presents indexing as the force that is gradually eclipsing the Sun King's reign, bringing transparency, low costs, and guaranteed market returns back to the forefront. The growth of index funds and ETFs is, in his view, a positive development that is slowly but surely reorienting the industry towards investor-centric principles. Advocacy for investor protection. This chapter serves as a call for greater investor protection and regulatory oversight.
Bogle often advocated for rules that would force fund companies to clearly disclose all costs and to truly act as fiduciaries for their clients. The Eclipse of the Sun King is a passionate plea for a return to common sense and integrity in the investment world. Bogle challenges investors to be wary of the industry's allure and to embrace the simple, low-cost path to financial security offered by indexing. It's a chapter that reveals Bogle's deep commitment to the individual investor and his frustration with an industry he believes has lost its way.
Chapter 8. The Investor's Enemy: High Costs. Chapter 8 is an emphatic reinforcement of John Bogle's central thesis. High costs are the single greatest enemy of the long-term investor. He dedicates this entire chapter to dissecting the various forms of costs, demonstrating their insidious nature, and providing irrefutable evidence of their detrimental impact on wealth accumulation. This is a crucial chapter for any investor seeking to understand the mechanics of long-term returns. Bogle reiterates that in the investment world, what you don't pay matters just as much, if not more, than what you earn. Every dollar paid in fees, commissions, or taxes is a dollar that cannot compound for the investor. He systematically breaks down the different types of costs that investors face. Expense ratios. This is the most obvious and often the largest cost. Bogle provides detailed examples of how even seemingly small annual fees, e.g. 1% or 1.5%, can erode a massive portion of an investor's wealth over decades. He compares a low-cost index fund with a high-cost actively managed fund, illustrating how the index fund's lower fees lead to dramatically higher ending wealth, even if both funds achieved the same gross investment returns. The mirage of gross return versus the reality of net return is a central theme. Sales charges, loads. While less common today than in Bogle's earlier career, he warns against funds that charge upfront sales commissions, front-end loads, or deferred sales charges, back-end loads. These are immediate wealth destroyers, taking a chunk out of an investment before it even has a chance to grow. Index funds, particularly those from Vanguard, are almost exclusively no-load funds. Transaction costs, brokerage commissions, and bid-ask spreads. These are often hidden costs, not explicitly listed in an expense ratio, but deeply impactful. Actively managed funds, with their high portfolio turnover, incur substantial trading costs. Every time a manager buys or sells a stock, there are commissions and the implicit cost of the bid-ask spread. Bogle explains that these costs directly reduce the fund's net return. Index funds, with their minimal turnover, largely avoid these expenses. Market impact costs. Related to transaction costs, Bogle mentions that large trades by actively managed funds can sometimes move market prices against the fund, resulting in higher purchase prices and lower selling prices. This market impact further erodes returns. Advisory fees. For investors who use financial advisors, Bogle stresses the importance of understanding and scrutinizing advisory fees. He advocates for fee-only advisors who charge a transparent flat fee or hourly rate, rather than commission-based advisors who may have conflicts of interest. He also highlights that if an advisor recommends high-cost active funds, the investor is essentially paying two layers of fees. Taxes. While not strictly an expense in the same way fees are, taxes on capital gains and dividends represent a significant drag on returns. Actively managed funds, due to their higher turnover, tend to generate more taxable events, reducing the after-tax return for investors in taxable accounts. Index funds, with their low turnover, are inherently more tax efficient.
Bogle's message is clear and unwavering. The best predictor of future fund performance is its expense ratio. Low costs are a powerful competitive advantage that compounds over time. He urges investors to become vigilant cost detectives, scrutinizing every fee and charge associated with their investments. He concludes by emphasizing that while market returns are uncertain, costs are 100% certain. By minimizing the things you can control, your costs, you maximize your probability of long-term investment success. This chapter serves as a stark warning and a powerful call to action for every investor to prioritize cost efficiency above all else.
Chapter 9. Taxes, the Silent Thief. In Taxes, the Silent Thief, John Bogle shines a spotlight on another insidious enemy of investor returns, one that often operates quietly in the background: taxes. While not a direct fee charged by fund companies, taxes on investment gains and income can significantly erode wealth over time, particularly in taxable accounts. Bogle emphasizes that a smart investor must always consider the after-tax return, not just the pre-tax return. He starts by asserting that the impact of taxes, like costs, compounds over time. Every dollar paid in taxes prematurely is a dollar that cannot compound for the investor, leading to a substantial difference in long-term wealth accumulation. Bogle primarily focuses on two main types of investment taxes: taxes on income distributions, dividends and interest. Dividends: stock funds distribute dividends, which are taxable in the year they are received, unless held in a tax-advantaged account like a Roth IRA or 401k. Interest: bond funds distribute interest income, which is also taxable. Bogle points out that bonds often generate higher levels of taxable income compared to growth stocks, making their tax efficiency a significant consideration. He highlights that while qualified dividends and long-term capital gains are taxed at lower rates for many investors, these taxes still represent a drag on returns that can be avoided or deferred. Taxes on capital gains distributions. This is where actively managed funds often fall short. When an actively managed fund sells a stock for a profit, it incurs a capital gain. If the fund manager realizes net capital gains over a year, these gains must be distributed to fund shareholders, who then owe taxes on them, regardless of whether they sold any of their fund shares. Bogle explains that high portfolio turnover, a hallmark of active management, directly leads to more frequent realization of capital gains, and thus more capital gains distributions. This forces investors to pay taxes annually, disrupting the powerful effect of tax-deferred compounding. The tax efficiency of index funds. This is where index funds, particularly total stock market and total bond market index funds, demonstrate a significant advantage. Bogle elaborates on why they are inherently more tax efficient. Low portfolio turnover. Because index funds simply track an index, they only buy and sell securities when the index itself changes, e.g., when a company is added or removed. This results in extremely low portfolio turnover, often less than 5 to 10% annually, compared to 50 to 100% or even higher for actively managed funds. Minimal capital gains distributions. Due to low turnover, index funds rarely realize substantial capital gains that need to be distributed to shareholders. This allows investors to defer capital gains taxes until they decide to sell their own shares of the fund, maximizing the time their money can compound tax-free. Tax loss harvesting, less relevant for funds.
While not a direct fund feature, individual investors can often benefit from tax loss harvesting with ETFs, an advantage less common with traditional mutual funds. Strategies for tax-smart investing. Bogle offers practical advice for investors to mitigate the impact of taxes. Utilize tax-advantaged accounts first. Prioritize investing in retirement accounts like 401ks, 403bs, IRAs, traditional or Roth, and HSAs. These accounts offer tax deferral or tax-free growth, allowing investments to compound untouched by annual taxes. Place less tax-efficient assets in tax-advantaged accounts. For example, put actively managed funds, if you insist on owning them, bond funds, which generate taxable income, and REITs, real estate investment trusts, which often have high dividend payouts, in tax-advantaged accounts. Place more tax-efficient assets in taxable accounts. Low-cost broad market stock index funds and ETFs are ideal for taxable accounts due to their low turnover and minimal capital gains distributions. Be mindful of fund structure. Exchange-traded funds, which are typically index funds, often have a more tax-efficient structure than traditional mutual funds due to their creation-redemption mechanism. Taxes, the silent thief, serves as a crucial reminder that net returns are what truly matter. By understanding how taxes impact investment performance and by strategically using tax-efficient investment vehicles and accounts, investors can significantly enhance their long-term wealth accumulation, allowing the power of compounding to work its full magic.
Chapter 10. The Triumph of Indexing. In The Triumph of Indexing, John Bogle celebrates the remarkable success and growing acceptance of the investment strategy he pioneered. This chapter serves as both a vindication of his lifelong advocacy for index funds and a look towards the future, where he envisions indexing as the dominant and preferred investment approach for sensible investors. Bogle opens by unequivocally stating that indexing has triumphed because it delivers on its promise, providing market returns at minimal cost, consistently outperforming the vast majority of actively managed funds over the long run. He points to the phenomenal growth of index funds and exchange-traded funds, ETFs, as concrete evidence of this triumph, moving from a niche concept to a mainstream investment choice for millions. Key aspects of the triumph of indexing discussed include statistical proof of outperformance. Bogle marshals extensive statistical data to demonstrate that index funds, particularly those tracking broad market benchmarks like the S&P 500 or the total U.S. stock market, have consistently beaten a significant majority, often 70 to 90% or more, of virtually all meaningful long-term periods, 10, 20, 30 years. This is not a matter of opinion, but an empirical fact. The fading of active management. He contrasts the robust growth of index funds with the decline or stagnation of many actively managed funds. He suggests that the smart money is increasingly flowing into passive strategies, recognizing the futility of trying to beat an efficient market after costs. The power of simplicity. Bogle continually champions simplicity. The triumph of indexing is, in part, a triumph of common sense over complexity. Investors are realizing that they don't need to engage in complex analysis, stock picking, or market timing to achieve their financial goals. A simple, diversified, low-cost index fund portfolio is often the most effective. Cost as the decisive factor. He reiterates that costs are the primary determinant of long-term investment success. The low expense ratios and tax efficiency of index funds create an insurmountable advantage over their actively managed counterparts.
The triumph of indexing is fundamentally a triumph of low cost. Democratization of investing. Bogle sees indexing as a powerful tool for the democratization of investing. It provides ordinary investors with access to institutional quality diversification and market returns, previously only available to the wealthy or those with expensive advisors. This aligns with his mission of putting investors first. The silent revolution. He refers to the rise of indexing as a silent revolution in the financial industry. It's a revolution driven by mathematics and common sense, quietly but powerfully transforming how people invest. Future outlook. Bogle expresses optimism that indexing will continue its ascent. As more investors become educated about the power of costs and the futility of active management, the movement towards passive investing will only accelerate. He believes that fiduciary standards within the industry, if properly enforced, will further push advisors and institutions towards low-cost indexing solutions. Vanguard's role. While humble, Bogle implicitly highlights Vanguard's crucial role in this triumph. By pioneering the index fund and operating under a unique client-owned structure, Vanguard has been at the forefront of driving down costs and making indexing accessible to the masses. The triumph of indexing is a celebratory chapter, but it also serves as a final, powerful call to action for investors. It encourages them to embrace the proven, common-sense path to financial security, to ignore the siren song of active management and market speculation, and to trust in the simple, elegant power of owning the market at the lowest possible cost. It's Bogle's ultimate testament to the efficacy and integrity of investing.
Chapter 11. The Investor's Manifesto. Chapter 11, The Investor's Manifesto, serves as John Bogle's concise and powerful summary of his entire investment philosophy. It distills the wisdom of the preceding chapters into a set of actionable, enduring principles for intelligent investing. This chapter is designed to be a clear, unambiguous guide for investors to follow, a manifesto to declare their independence from the often detrimental practices of the financial industry. Bogle outlines 8 fundamental rules or principles that, if adhered to, will virtually guarantee long-term investment success and ensure investors capture their fair share of market returns. These principles are rooted in common sense, simple arithmetic, and a deep understanding of market dynamics and human behavior. Here are Bogle's 8 rules of the Investor's Manifesto. Select low-cost index funds. This is the cornerstone. Bogle reiterates that costs are paramount. Investors should choose broad market index funds like total stock market or S&P 500 index funds that charge minimal expense ratios. This ensures that the investor keeps more of the market's return. Consider costs carefully. Beyond just expense ratios, Bogle urges investors to be hyper-aware of all costs: sales loads, trading costs, advisory fees, and even taxes. He emphasizes that what you don't pay is just as important as what you earn. Beware the big 4 enemies of return: costs, taxes, inflation, and speculation. Costs, as discussed, they relentlessly erode returns. Taxes, the silent thief that reduces after-tax wealth mitigated by tax-advantaged accounts and tax-efficient funds. Inflation, the long-term destroyer of purchasing power, which stocks and, to some extent, tips help to combat. Speculation, the pursuit of short-term gains, market timing, and chasing hot stocks or funds, which almost invariably leads to poor returns. Use past performance as a guide to the future at your peril. Bogle vehemently warns against relying on past performance as an indicator of future results. He provides ample evidence that funds that outperform in one period rarely continue to do so. Chasing past winners is a common investor mistake that often leads to buying high and selling low. Asset allocation matters. Investors must determine an appropriate mix of stocks and bonds based on their individual risk tolerance, investment horizon, and financial goals. He recommends a simple age-based rule, e.g., bond allocation equals your age, but stresses that it's a personal decision. Rebalance your portfolio regularly. Over time, the stock and bond allocations in a portfolio will drift due to varying market performance. Bogle advises periodic rebalancing, e.g., annually, to restore the target allocation. This helps manage risk and provides a disciplined approach to buying low and selling high. Simplicity trumps complexity. Bogle consistently advocates for a simple, straightforward investment strategy. Avoid complex financial products, exotic strategies, and the endless pursuit of perceived edge. A portfolio of a few low-cost, broad-market index funds is usually all that's needed. Stay the course. This is perhaps Bogle's most important behavioral advice. Investing successfully is about discipline, patience, and emotional control. Investors must resist the urge to react to market fluctuations, media hype, or short-term performance. Stick to your long-term plan through bull markets and bear markets and let the magic of compounding work its wonders. The Investor's Manifesto is not just a summary. It's a declaration of principles for empowering the individual. It's a testament to Bogle's unwavering belief that common sense, discipline, and a focus on what can be controlled, costs and behavior, are the true keys to building wealth in the stock market. It's a powerful call to action for every investor to embrace these timeless truths and secure their financial future.
And that brings us to the end of our deep dive into John C. Bogle's The Little Book of Common Sense Investing. What an insightful journey, packed with timeless wisdom that cuts through the noise of the financial world. Bogle's message is clear, powerful, and liberating. Embrace simplicity, minimize costs, diversify broadly with index funds, and most importantly, stay the course. Remember, investing isn't about beating the market. It's about letting the market work for you. It's about capturing your fair share of returns, and this book provides the blueprint to do exactly that. If you found this summary helpful and inspiring, please show your support by hitting the like button, sharing this episode with friends and family who could benefit from Bogle's wisdom, and subscribing to the Book Mint channel for more illuminating summaries of the world's best books on finance, personal development, and success. Thank you for tuning in. Until next time, happy investing, and remember, knowledge is power, especially when it comes to your financial future.